The Bank of Canada held its overnight rate at 2.25% this morning, and a narrow technical view of this, the decision is understandable. The economy is weak in places that matter. Consumer confidence is low. Housing is limping. Business investment is uncertain. And trade policy such as CUSMA is a major wild card in the Canadian economy. Now, of course, all of this is balanced with some significantly increased oil prices, which is preventing some parts of the Canadian economy from performing well and allowing other parts of the economy to perform well. Oil is a major factor in production costs right along every part of the Canadian economy and affects prices in every industry. And production input costs are being bounced around by these higher energy prices, trade uncertainty, and even geopolitical uncertainty. And for all these reasons, the Bank of Canada has decided to put everything on hold and just simply wait it out. But that is also part of the problem. This decision doesn't display confidence about the direction of the economy. It displays hesitation. It feels less like a central bank guiding policy and guiding the economy, and more like a duck in the middle of a pond waiting for the hunter to shoot it right out of the water. Now that may sound a little harsh, but the point is not whether the Bank of Canada should or should not have increased or lowered rates. The point is much deeper than that. The point is that the Canadian economy has, over a long period of time, built a reliance on monetary and fiscal policy. In fact, people in the economy wait for people in the ivory tower to decide what policy should look like before determining what reality should look like with boots on the ground. The Bank of Canada hesitates. The Ministry of Finance produces another fiscal update. And in the interim, markets, borrowers, investors, builders, entrepreneurs, and consumers stand on the sidelines and wait. And underneath this all, I think it brings up a very uncomfortable question. How did Canada, a country full of land, resources, energy, and entrepreneurial capacity, become so dependent on politicians and the Bank of Canada before making any decision to do things and pursue opportunities? And that's the real story behind this Bank of Canada announcement today. The overnight rate is not just a number. It is one of the most important prices in the economy. It prices money. Not only does it define the cost of mortgages, business loans, and government borrowing costs, but it influences the willingness of households, entrepreneurs, and investors willing to take a risk. But the overnight rate isn't supposed to be a political signal. In a functioning market, the price of money or the interest rate is supposed to be a coordinating mechanism. It reflects the relationship between borrowing and saving, future consumption or present consumption, risk and reward, or urgency or patience. Murray Rothbard explained this as the time preference of money. People do not value present goods and future goods equally. Some people are willing to save, defer consumption, and save up for future production. Others want resources now and are willing to pay a premium to get them today. The interest rate is the free market's way of coordinating these competing preferences. And that is why artificially manipulating the overnight rate and the interest rates is not a neutral act. When interest rates fall, people are generally saving more, and that provides a signal. It tells entrepreneurs that real capital is available for longer-term investment. It suggests that society has deferred their purchases and are willing to wait for future production. But when rates are pushed down through central bank policy, the signal becomes muddled. It becomes different. Cheap credit may appear to create prosperity, but it's actually misleading households, investors, businesses, and governments to make decisions now that may be unsound, and to believe that more savings exist than actually do exist. Development and housing projects look more commercially viable. Consumers borrow more freely, and governments find it easier to finance deficits. Asset prices rise, and everybody feels wealthier for a period of time. But the wealth is not necessarily real. It is the result of distorted credit conditions. And that's the warning of Austrian economics. The boom can feel productive even if it's partly built on false signals. And Canada's housing market is one of the most well-defined results or examples of this. Housing is not just another sector of the Canadian economy. It's a major driver of bank profits, employment, municipal revenue, and household wealth. When the Canadian housing market feels strong, everybody feels prosperous. And when the weakness emerges, and it always emerges, people feel more fragile. The Bank of Canada has acknowledged that the housing market has weakened significantly. And of course, there are many, many factors that are weighing on that market. CREA's numbers showed that housing was relatively flat month over month, and the MLS Home Price Index is showing that across the country, housing prices are down meaningfully. CMHC has also pointed that the momentum in the home construction market has meaningfully dropped as well. Now, all these institution numbers are fairly abstract until you take them down to the street level. Among all the top producing real estate agents across British Columbia, the top 10% producers are roughly producing about a half to a third of the sales that they were doing just even 3 or 4 years ago. And that's a signal that matches what the broader data is saying. The housing market is weak and confidence is quite thin. A huge part of the Canadian economy is struggling to find footing. Now, the easy answer would have been to suggest that the Bank of Canada should have cut rates, but that's too simple of an answer. Lower rates may have helped borrowers to improve mortgage affordability and get more people into the market, but lower rates do not fix the underlying problem. They do not create real affordability or remove municipal bottlenecks. They do not lower regulatory costs or solve the problem of productivity. They do not transform the Canadian economy into one reliant on housing to one that relies on production of goods. At best, lower rates are going to relieve the pressure valve. And on the other side, they can reinflate the distortions that created the problem in the first place. And this is where monetary policy and fiscal policy look like two sides of the same failure. The Bank of Canada is watching, waiting, trying not to make a mistake. And Ottawa yesterday just released its spring economic update filled with targeted measures. This includes housing relief, affordability programs, skilled trades programs, an industrial strategy, and a government-directed investment platform. The stated goals are altruistic and attractive: more housing, more investment. And of course, the rhetoric is centered on national strength. But the question isn't whether these goals sound good. Of course they sound good. The question is whether or not the political allocation of capital is superior or not to the market allocation of capital. From a libertarian perspective, that answer begins with skepticism. Government cannot create resources out of nothing. If it subsidizes one sector, it must take the production of another sector in order to fund the sector it wants to promote. If it borrows, the capital still has to come from somewhere. If it spends, then labor and materials have to be pulled into more politically favored areas. If it provides some temporary relief, it may soften the pain in the short term, but it doesn't address the structural problems that made life unaffordable in the first place. And herein lies the great Canadian contradiction. Ottawa says it wants to help with affordability, but policy was what made life unaffordable in the first place. Weak productivity, heavy regulation that has filtered down to the municipalities, cheap credit, large deficits. And then when these consequences become politically painful, government announces new measures to manage the damage. And this, of course, is not prosperity, it's economic triage. And the issue with high oil prices makes all of this more complicated. Higher oil prices can help Canada on paper. We are an energy-rich country, which can drive government revenues, as was mentioned in the spring economic update, increases energy sector prices, and makes the overall economy a little bit better than it would. But higher prices hurts many households and businesses. It rises the cost of gasoline, diesel, fuel, fertilizer, plastics, food production, and affects the input costs of every sector and industry that relies on transportation and energy. So while one part of the economy may look profitable and great, the other part is getting squeezed. And that's why we have to be careful with the word inflation. Ludwig von Mises warned that modern language confused inflation with its consequences. What most people and many pundits on TV call inflation is rising prices. But Mises argued that inflation is an increase in the volume and supply of money and money substitutes. Rising prices are a consequence, and that distinction matters when you hear the media talk about inflationary prices of oil. An oil shock in prices is not the same as monetary inflation. It's a relative price change. It's the market telling us that a key input in the economy has risen in price. And that may be painful, but it's still merely information. Prices are not merely inconveniences. Prices are signals. When gasoline prices rise, it forces households to economize. When construction costs rise, it tells builders something about scarcity. When interest rates rise, it tells borrowers that capital is not free. When housing sales slow down, it tells policymakers and markets that affordability has reached a boiling point. Prices and the markets are continuing to communicate what these signals mean to different areas of the economy and the different players within it. And the problem is that policymakers want these market signals suppressed, controlled, or manipulated. As prices rise, governments look towards subsidies. Housing becomes unaffordable, and government looks towards a program. Borrowers are getting squeezed, and everybody's waiting for a decision from the central bank. When businesses hesitate, Ottawa announces a new program. But every attempt to mute a painful price signal risks obscuring the information that the economy needs to adapt. This is the core Austrian critique of economic management. The economy is not a machine. It's not merely a dashboard. It's not something that can be fine-tuned by pulling a lever here or making a program announcement there. The economy is a process of human action. Millions of people all together save, build, borrow, lend, fail, and start all over again. No central bank or finance department can replace that process. They can influence it and they can distort it. They can delay its corrections and they can remove pain from one point of the economy and give it to another point, to be sure. But they cannot centrally plan Canada into prosperity. And that's what the combination of today's Bank of Canada announcement and yesterday's spring economic update reveal. Monetary policy is hesitant because signals are mixed. Fiscal policy is activist because the political pressure is intense. Housing is weak. Oil is both helping and hurting. Consumers are squeezed. Businesses are facing uncertainty. Government deficits remain large and productivity is poor. And policymakers keep reaching for more tools, more strategies, more programs, and more intervention. And Canada's problem is not a shortage of economic management. Canada's problem is a reliance on economic management. For families and business owners, the lesson is simple but uncomfortable. Do not build your financial life on the assumption that policymakers know what they're doing. Do not assume that the next rate cut will create affordability or that government programs create real wealth. Do not confuse nominal gains with actual production. And do not mistake a managed economy for a healthy one. Real wealth still comes from saving, investment, deployment, and allocation of capital. That's true for a household, it's true for a business, and it's true for a country. So yes, the Bank of Canada held its overnight rate at 2.25%, but of course that is not the real story. The bigger story remains that Canada remains trapped between a central bank that's trying to manage the cost of credit and a federal government that's trying to manage the consequences of its economic model. The market data is telling the truth. Housing market data is telling the truth. The decline of business investment in Canada is telling the truth. And consumer confidence is telling the truth. And the real question is whether policymakers are willing to listen to these truths and these signals or not. Because the Bank of Canada can administer the overnight rate and Ottawa can announce another program. But neither of them can repeal the truth about scarcity. Neither of them can manufacture productivity, and neither of them can substitute for entrepreneurship. And neither of them can replace the coordinating power of real prices in a market. Canada does not need more economic theater. It needs more respect for price signals, fiscal discipline, capital formation, and productive investment. Until then, today's rate hold is not a sign of strength. It's another symptom of a country waiting for policymakers to solve the problems that policy created. If you found this video to be helpful in your discovery of history, politics, economics, philosophy and financial literacy. Make sure that you like, subscribe, and hit the notification bell for upcoming videos.